Howdy, folks. Rick Wedell here. I'm the Chief Investment Officer at RFG Advisory. Thought we would come to you today with a brief market update, kind of let you know what's going on out there. S&P 500 right at about 6,100 as the time I'm talking. It's actually pretty flat for the last month. Now, it's been up and down. There's been a little bit of gyration in that number, and we will talk about that towards the end of this market update. But if you just think about where we came into the year, we ran up a little bit during the beginning of January. And then ever since sort of mid-January, mid to late January, we've been kind of in this range between about 6,000 and 6,100. So just kind of hanging in there. It is kind of quiet out there right now. We've got a little bit of a wait and see attitude with the approach to tariffs. The administration has thrown out a number of proposed tariffs that are out there. They have indicated some willingness to negotiate on those tariffs, waiting to see what trade partners are basically going to do, particularly over in Europe, to maybe try and placate the administration. And so there's a little bit of a wait and see attitude with respect to that particular bit of news. We've also got earnings going on in the marketplace, wrapping up actually. About 40% of the S&P 500 is kind of reported at this point, and we've seen about 10% growth in earnings versus about 8% expectations. So a relatively solid earnings season to kind of round out the sort of more macro news. I will just comment, because I think it's important for everybody to understand that human beings have something called recency bias, which is that we generally expect whatever is going to come in the future to be very similar to whatever we most recently experienced, just in the past, year or two. And in that case, I think it's important to highlight just market volatility. The average market going back over the last 60 years, we'll see north of 50 days, almost 55 days per year, where the S&P 500 moves by plus or minus 1% in a day. These big days where you get a big announcement, or a company does something, or a bunch of companies do something, or maybe there's some government policy shift, or a big earnings report, or CPI number, or something else like that, and you get this big market movement. And I would just note that in 2023 and 2024, we actually saw those numbers dip down to about 38 days per year, where the S&P 500 moved by more than 1%. And so I'm hearing a lot of people, as we get into 2025, talk about, oh my goodness, the market just feels so volatile. I'd just like to remind everybody that, we've had 7 days so far this year where the market has moved by, more than 1%. That would be on track for somewhere around 60, maybe a little south of 60 days. With plus or minus 1% moves, which is the historic average volatility for the market. It feels a little bit more volatile this year because we've been used to 23 and 24, which were relatively quiet. But just would like to remind everybody that the volatility that we're seeing in the marketplace is actually normal for markets. Markets are supposed to do that sort of up and down motion through the course of the year. And so as you think about, your approach to 2025, just acknowledge that, yes, as we've said on previous episodes of Market Commentary, I do think that volatility will probably be a little bit heightened this year, certainly versus 2023 and 2024. That's not actually necessarily a terrible thing. In fact, it's more of a return to market norm than it is something that we have to be wildly concerned about. So with that, as always, if you have any questions, please feel free to reach out to myself or to your financial advisor. Hope you're having a great day, and I look forward to talking to you again soon.